Welcome back to the Deep Dive.
Great to be here.
This week, we're plunging really headfirst into what our sources describe as a truly wild and, frankly, pretty perplexing period in the U.S. FX market.
Yeah, it was quite something.
We're talking specifically about the week of July 7th to 11th, 2025. You've sent us a fantastic stack of material articles, research notes, and our mission today is, well, to cut through the noise, find those connections, and pull out the most important nuggets for you.
Sounds good. There's a lot to unpack.
What immediately jumped out at me from the material is that this wasn't your typical, risk-on, risk-off week. Much more intricate.
Definitely not.
Our sources keep using phrases like profound market-wide tug-of-war and significant fragmentation. So what was driving this complex environment?
That's really the core finding, isn't it? What's truly fascinating here is how the market environment just defied those simple boxes. We saw significant cross-asset divergences. Basically, different assets, different currency pairs, they were reacting to different bits of a really complex, sort of multi-layered news flow.
Okay.
And the primary market tension, as our research points out, came directly from the U.S. dollar's almost paradoxical position.
Paradoxical how?
Well, on one hand, the dollar was, undeniably the source of global risk, mostly through the U.S. administration's incredibly volatile tariff policy.
Right.
But at the same time, it acted as the ultimate haven from that exact same risk.
Ah, okay.
Yeah, as the world's main reserve currency, the dollar actually benefited from big capital inflows precisely when global trade and growth were under threat.
So the threat itself drove money to the dollar.
Exactly, that safe haven bid. And then on top of that, you had a fundamental bid based on pretty clear evidence of U.S. economic outperformance, especially that strong labor market.
Right, the jobs data.
Yeah, so this duality, it produced significant intraday volatility. And importantly, it really rewarded strategies that could differentiate, between the fundamentally driven strength and just the short-term sentiment-driven noise.
So if the dollar was playing this dual role, causing the storm but also being the safest harbor, how did that tension actually play out day to day for traders? Was it just constant whiplash, or were there patterns?
It definitely wasn't constant whiplash, which is key. I mean, it was volatile, sure, but those underlying patterns were crucial if you wanted to trade it successfully.
Okay.
Our sources make it pretty clear the market was constantly trying to price in which dollar narrative was dominant at any given moment.
Ah, okay. Like which hat was it wearing?
Sort of. So, for instance, when trade tensions flared up, the safe haven bid for the dollar got stronger. But then, say, strong U.S. jobs data came out, the dollar gained because of its fundamental strength. Understanding which driver was in the hot seat became, well, the critical differentiator.
Okay, that makes sense. Let's unpack this further then and dive into the specific events that shaped this complex week. Our sources highlight the top 10 FX market movers, and we'll group them for clarity. Let's start with the geopolitical forces setting the stage.
Right. The big one.
At the very top of our list, and you could argue it was the central theme of the whole week, was the U.S. tariff deadline extension and new threats. Now, this was an ongoing story, but it really hit the wires around July 9th, and it created this real yo-yo effect, didn't it?
It really did.
Initially, there was this temporary reprieve, right? A 90-day pause on reciprocal tariffs got extended to August 1st. Seemed like it averted an immediate shock. But our sources quickly point out this apparently dovish news was almost immediately nullified.
Absolutely nullified. What's striking is just how quickly that initial relief vanished.
Yeah.
The White House sent out letters to over 20 countries, including key partners like Canada, Brazil, Japan, South Korea, outlining new higher tariff rates. We're talking 25% up to a staggering 50%.
50%.
Wow. Yeah, if new bilateral deals weren't sorted by August 1st, Brazil, for instance, got specifically threatened with 50%, and they immediately vowed retaliation. So yeah, definitely not a simple risk-on-off event.
So even with that temporary extension, the market's still fragmented. Why didn't we just see a broad risk-on rally, which some might have expected?
Well, because, as our analysis suggests, the administration's strategy looked like a deliberate weaponization of uncertainty.
Weaponization of uncertainty.
Yeah, it prevented a broad market panic by kicking the can down the road on the deadline.
Right.
But it kept maximum negotiating leverage by issuing these very specific, targeted threats. So sentiment just swung wildly from deep fear before the deadline to initial relief, then boom, right back to anxiety over the new threats.
And the sentiment scores reflected that.
They did. Our sources show it moved from like manacle 75, which is pretty fearful, up to negative 40, still firmly negative territory.
Okay.
And cross-asset correlations, they fractured significantly. For example, the S&P 500 rallied on the extension news, while the Aussie dollar versus the US dollar, AUUSD, which is often seen as a proxy for global growth, actually stayed under pressure.
So major decoupling there.
Huge decoupling. The absolute change in correlation was over 0.45. So the big takeaway was this fragmentation of risk, not some single monolithic risk theme.
That makes perfect sense. So for the, let's say, the astute trader, what was the key strategic play here, given that fragmentation?
Well, our sources are pretty clear on this. The winning strategy seemed to be a pairs trade.
Okay.
Going long, the U.S. dollar playing on that dual role, right? Safe haven and beneficiary of U.S. resilience against the currencies of those targeted nations, like the Canadian dollar, Brazilian real, or against global growth proxies like the Aussie dollar.
So finding those divergent impacts was key.
Exactly. It was all about identifying who is getting hit hardest by the specific threats versus the dollar's broader appeal. Hashtag tag B, central bank policy decisions and divisions.
Okay. Now here's where it gets really interesting, I think. Central bank activity, those nuanced messages from policymakers.
Yeah.
That added another really complex layer this week.
Was absolutely a huge factor.
Let's start with the FOMC June meeting minutes. They came out on July 9th, and they revealed a Fed committee that was far more divided and leaning more dovish than the market had maybe initially thought.
That's right.
Rates were held steady in June, but the internal chat was all about tariff uncertainty. So what was the key revelation for the market in those minutes?
The key thing, the real kicker, was that most participants, that's 12 policymakers, signaled a rate cut would likely be appropriate in 2025.
12. Wow.
Yeah, and even a couple of members were apparently open to a cut as early as the July meeting.
Okay, so much more dovish than expected.
Much more, and this triggered an immediate dovish repricing in the bond market. U.S. two-year yields dropped over 7 basis points, pretty fast.
Right.
The minutes basically confirmed the market's Fed put narrative, the idea that the Fed is ready to step in.
The safety net.
Exactly. And it indicated their reaction function is now heavily tied to whatever the White House decides on trade policy. The bar for a rate cut seemed lower than people thought.
And sentiment.
Flipped dramatically. From cautiously hawkish, maybe a plus 20 score, to deeply dovish, like negative 65, right after the release.
And for traders watching this unfold in real time, what was the immediate correct read on that? How should they have played it?
Well, the initial USD negative reaction was indeed the correct one. The munter very quickly adjusted to that dovish lean from the Fed.
Okay.
And breakout strategies in equities like the NASDAQ, they also found validation. The idea of cheaper money potentially coming sooner rather than later gave stocks a boost.
Okay, building on that central bank theme, but with a surprising twist, let's talk about the RBA interest rate decision on July 8th, the Reserve Bank of Australia.
Ah, yes, the Aussie surprise.
A major surprise, right? They held their official cash rate steady. And I know the market was widely banking on a 25 basis point cut there, given their weakening economy and okay inflation. What was the impact of this unexpected hawkish surprise?
Oh, it was immediate and violent for the Aussie dollar. It surged over 110 pips. That was its largest single session move of the week.
110 pips. Huge.
Huge. And this move almost certainly triggered a massive short squeeze.
Positioning.
Exactly. The CFTC report, which tracks speculative positions, showed that non-commercial traders were heavily net short the Aussie dollar, like more than 4-to-1 short.
They were caught way offside.
Completely offside. The unexpected hold forced tons of them to cover those short positions at a loss, which just amplified the rally, poured fuel on the fire.
Right.
It was really the week's clearest example of a central bank surprise just driving currency move, where bad positioning turned a surprise into an explosive, high-momentum rally.
And did the Aussie decouple from risk then?
Totally decoupled. Its usual correlation with things like the S&P 500 just broke down. The absolute change was over 0.50. It was all about the RBA.
Wow. So for anyone who caught that, what were the best opportunities?
Well, breakout strategies on AUD pairs were obviously highly profitable. And it also created excellent opportunities in the crosses, particularly going long AUD-NZD. We'll probably touch on the NZD part in a second.
Yeah, let's hold that thought, because then just a day after the FOMC minutes, on July 10th, we heard from 3 key Fed officials, Waller, Daly, and Musalem.
Right, the speeches.
And they publicly exposed these deep divisions within the committee. How did this impact market sentiment, especially coming right after those dovish minutes?
Well, it led to sentiment just oscillating wildly. I mean, back and forth, dovish, hawkish, dovish again.
Okay.
You had Governor Christopher Waller, normally seen as a hawk, surprisingly saying a July rate cut could be considered. He actually said policy is too tight.
A hawk saying that? Interesting.
Very interesting. But then, in stark contrast, you had St. Louis Fed President Alberto Musalem warning that tariffs could actually fuel inflation. Completely different take.
Right.
And then, meanwhile, San Francisco Fed President Mary Daly sided with the doves, saying she favored 2 cuts this year.
So all over the map.
Pretty much. And the analysis highlights that in such a divided FOMC, individual speeches by voting members can be really significant market movers because the market is actively, vote counting.
Trying to figure out which way the committee leans overall.
Exactly. In the end, the net dovish tilt from 2 out of the 3 speakers seemed to carry a bit more weight that day.
So for active traders, the lesson from these speeches was pay attention to the details and seize those intraday shifts.
Absolutely. Traders who just ignored these speeches definitely missed out on significant intraday moves. It really reinforced that every word from a voting member was being put under the microscope.
Okay, now let's move across the Tasman Sea, as you hinted. The RBNZ interest rate decision on July 9th, Reserve Bank of New Zealand.
Right.
As widely expected, they cut their official cash rate by 25 basis points, trying to support their economy amid global uncertainties, slowing growth. Pretty standard stuff.
Yeah, that part was expected.
So what's the real significance of this decision then, especially given the RBA's surprise hold just hours before?
The significance lies precisely in that stark contrast to the RBA's hawkish hold.
Okay.
This created a really significant policy divergence between the 2 neighboring economies, Australia holding, New Zealand cutting.
Right.
And that led to what our sources called the week's cleanest policy divergence trade. It was a clear, fundamentally driven opportunity, pretty much independent of what broader global risk sentiment was doing.
And for anyone looking for that clean trade, that divergence play, what was the highest probability strategy?
Without a doubt, going long AUDNZD, long the Aussie, short the Kiwi.
Capitalizing directly on the hawkish RBA versus the dovish RBNZ.
Exactly. It was a textbook example of central bank divergence playing out nicely in a cross rate. #, see economic data and market reactions.
Okay, so beyond policy decisions and geopolitics, we also had a barrage of economic data playing a crucial role, adding even more layers to this week's complexity.
Yep, the data points mattered too.
Let's start with China CPI and PPI data on July 9th. China's June inflation numbers confirmed persistent deflationary pressures, didn't they? CPI was flat. PPI declined 3.2% year over year.
That's right. Pretty weak numbers.
What were the implications of those figures for the FX market?
Well, they really underscore the deflationary hit from all the trade uncertainty, plus China's own kind of stalling post-COVID recovery.
Okay.
For FX markets specifically, this data provided a really strong fundamental reason to sell the AUD and NZD.
Because they're proxies for China's health.
Exactly, key proxies. And interestingly, the correlation between IUD/USD and copper prices, copper being super sensitive to Chinese demand, that correlation actually strengthened significantly on this news. It highlighted that direct link.
So for traders, what was the optimal move given this weak China data?
The clearest strategy was probably shorting AUD/USD or NZD/USD, or maybe establishing a long position in a cross like EURAUD, playing Euro strength against Aussie weakness.
Got it. So China's internal struggles remained a big headwind.
A major headwind for its trading partners, yeah, regardless of other global events that week.
Okay, next up, U.S. initial jobless claims on July 10th. You mentioned this earlier. This was a classic trap for headline watchers, wasn't it?
It really was.
Initial claims actually fell below forecasts, signaling, continued resilience in the U.S. labor market on the surface. But there was that contradictory signal.
Yes, exactly. The contradictory and frankly more concerning signal came from continuing claims, people staying unemployed longer.
Right.
Those rose to their highest level since November 2021. Which confirmed this kind of low firing, but also low hiring dynamic in the market.
So a whipsaw event.
Definitely a whipsaw event. Caused volatility to spike on the headline number, then spike again as traders kind of digested the conflating details in the continuing claims.
So that initial USD positive move
Was a bull trap, yeah. The more nuanced and ultimately correct interpretation was that while the labor market was still solid overall, it was definitely showing signs of fraying at the edges. And that provided justification for both the Fed hawks and the doves, funnily enough.
So how did the smart money play this one then, if the first move was wrong?
Mean reversion strategies generally did well here, selling that initial USD spike. It really paid off to look beyond the headline and dig into the underlying details.
Okay, let's turn our attention north now to the CAD employment data. On July 11th, Canada's June jobs report came in significantly weaker than expected. Job losses, higher unemployment rate, and this weak data landed in a market already nervous about Canada's outlook, especially with that new 35% U.S. tariff threat hanging over them.
Yeah, the timing was terrible for the Canadian dollar.
So, perfect storm.
It really created a perfect storm against the CAD, provided a very clear fundamental reason for Canadian dollar weakness.
And did the oil correlation hold up?
Interestingly, no. The correlation between USD CAD and WTI oil prices, normally a key driver for the loonie, actually weakened significantly.
Suggesting domestic and geopolitical factors were just overriding it.
That's how it looked, yeah. Those factors were just more powerful at that moment.
Seems like a straightforward opportunity for a change then. What was the most effective strategy?
Well, compared to some of the other events, this one was relatively straightforward. A long USD CAD breakout trade was probably the most effective strategy. All the ducks were lining up for Canadian dollar weakness there.
Okay, on the same day, July 11th, we also got UK GDP data for May. Showed a modest rebound, 0.2% growth, slightly beat forecasts. But it feels like this positive data kind of got lost in the shuffle, didn't it?
It really did. This was a classic second-tier data release. Its impact was just largely muted by those bigger, more powerful global narratives.
Like the tariffs and the Fed talk.
Exactly. The UK data simply wasn't strong enough on its own to drive a sustained, independent rally in the pound. It just got drowned out.
So, despite the positive local news, the best strategy was still to keep an eye on the bigger picture, the U.S. dollar's direction.
Pretty much, yeah. Acknowledge the UK data, sure, but continue trading GBP-USD based on the primary drivers of the week, the U.S. dollar's direction, and those overarching themes we've been discussing.
Okay, and finally, we had the June NFP report digestion. This wasn't a single event, but the market spent the week kind of digesting that strong U.S. non-farm payrolls report from the previous week.
Right, it was still echoing.
Initially, it was a bullish catalyst for the USD, right? But its influence seemed to evolve as it got reinterpreted through the lens of those dovish FOMC minutes and the escalating trade tension.
That's a great way to put it, evolved.
So what's the key lesson here about strong economic data in this kind of environment? Does good news automatically mean a stronger dollar?
Not necessarily. The key lesson here is that in this current environment, strong economic data does not automatically translate to a hawkish central bank. Not anymore. The market's reaction function is now heavily filtered through, well, geopolitical risk and the Fed's perceived willingness to ease policy preemptively. That Fed put, again.
Right.
So while that strong NFP report provided a kind of fundamental floor for the USD, stopped it from collapsing maybe, it just wasn't enough on its own to drive a sustained breakout against that dovish tide coming from the Fed minutes and the speeches. It became more of a supporting character in a much larger drama.
Wow. That's a lot to unpack. It really shows just how many layers were influencing the market that week. Can you imagine trying to trade that in real time, the cross currents?
It was definitely a week that rewarded nuance, patience, and a deep understanding of those interconnections. Simple reactions to headlines probably didn't work out too well.
So let's synthesize all this.
Yes.
What does it all mean for you, our listeners? Let's try and distill the crucial lessons from this incredibly complex week in the FX markets. Let's get to the brass tacks.
Okay, sounds good. From our deep dive into all those sources, here are what seem to be the top insights for you. First, the most volatile event. Now, while the RBA decision caused that explosive move in the Aussie...
Yeah, that 110 pip jump.
Exactly. But overall, the U.S. tariff deadline extension and new threats stands out as the most volatile event for the market as a whole.
Because it hit everything.
Right. It created sustained market-wide volatility. And more importantly, it drove that fragmentation of risk we talked about. It impacted pretty much every major currency pair, equity index, commodity. It was really the central theme everything else was measured against.
Okay, that makes sense. What about the best pair for breakout strategies?
AUD-NZD was the real standout there.
The divergence play.
Exactly. Those back-to-back central bank decisions, the RBA's hawkish hold, and the RBNZ's dovish cut created this rare and powerful policy divergence. That gave a clear, fundamental catalyst for a high-momentum breakout that was pretty much independent of whatever else was going on with global risk sentiment. A cleaner trade.
Got it. Now, what about the common trader mistake this week? What did people get wrong most often?
Well, according to our sources, the most common mistake was probably attempting to call a top in the US dollar.
Trying to fade the trend.
Yeah, based on maybe overbought technical signals or just a simplistic reading of those dovish FOMC minutes. That approach really ignored the dollar's powerful dual drivers, that safe haven appeal right alongside the underlying U.S. economic resilience relative to everywhere else. Fading the USD trend just proved to be a consistently losing strategy that week.
Okay, don't fight the tape, especially when the fundamentals and haven flows align.
Pretty much. And finally, some portfolio adjustment recommendations based on this analysis, thinking about the next week's potential movements.
Okay, what should people consider?
First, reduce exposure to USD shorts. The fundamental case for the dollar seemed pretty strong coming out of that week, until there's a significant de-escalation in trade tensions or a sharp downturn in U.S. data. The path of least resistance for the dollar looked higher. Second, hedge long equity positions. The environment where stocks rally on bad news because everyone expects the Fed to cut rates, that's seen as inherently unstable.
Right, relying on the Fed put.
Yeah. So consider hedging long equity exposure, maybe with positions like long USD JPY or long the dollar index DXY. The thinking is, in a true risk-off scenario where the Fed put gets questioned, both stocks and USD JPY would likely fall, but the DXY itself would probably rally hard.
Interesting hedge structure.
And third, focus on policy divergence in crosses. Continue looking for opportunities in those currency crosses driven by clear central bank policy differences, with the Fed signaling dovish, but other central banks reacting to their own domestic situations. Pairs like AGI-CAD, maybe E or GBP, and definitely AUD and ZD might offer cleaner trends than trying to trade the majors against the complex dollar.
Focus on those relative value plays.
Exactly. Hashtag outro.
Wow. What an incredible deep dive into the real nuances of currency markets and global economics just in that 1 week. The complexity of all these interlinking factors is truly fascinating. And it's clear, isn't it, that understanding the layers beneath the surface is more critical than ever.
Absolutely. Headlines rarely tell the whole story, especially these days.
So for you listening, here's something to mull over, a provocative thought, perhaps.
Yeah.
How often do these seemingly contradictory market movements, like stocks rising on what looks like bad news, how often do they actually signal these deeper, more complex narratives about central bank reactions, geopolitical chess matches, and how will you apply that insight, that way of thinking, to your understanding of future market dynamics? Something to think about.
Definitely food for thought.